While the anchors at CNBC are busy talking about Bitcoin and talking about what's going to happen in 2023, the global recession, and all that type of stuff, they haven't been really talking about gold, mainly because it's boring, they don't get a lot of advertising money from it, and it just doesn't excite retail investors. But gold has been making very big moves, and especially the gold miners, which I'm going to talk about in this video. But this is a screenshot that I took of the price of gold 2 days ago, which made over a 3% move in just one day. Now this is a massive move for a commodity and a precious metal was like gold. This is not Bitcoin. Bitcoin can move 10 to 15% and it's just normal in one day. But 3% for the price of gold is a very big move, and it does have a lot of meanings which I believe investors are overlooking in the market. And many of you guys asked me in the comments if I believe gold would still be performing amazingly well going into 2023 and beyond. So I decided to do this video and talk about the investment case with gold, and especially the gold miners, the risks associated with such investment, and how they can actually perform going into 2023 and beyond. So again, I hope you enjoy this video. Now looking a little bit deeper at the GDX, which is the gold miners ETF, it went up over 40% from the lows. 40%. They were trading at March 2020 lows, and I have been personally adding to my junior gold miner, and I did post a lot of tweets when this was actually happening on Twitter, trading at pretty much COVID lows. Many stocks like Barrick Gold were trading at a 20-year low. They were paying massive dividends. The dividends are still massive, and no one really wanted to touch those stocks, yet those stocks are up over 40% from the low, and they get no coverage on YouTube, very little coverage from mainstream media and CNBC and Bloomberg, but they have been making pretty massive moves. And many of you are actually looking at that, are asking, maybe are they too expensive right now? Is it still a good time to get exposure to this industry, and what could potentially happen going into 2023? And I'm gonna cover all of that now in this video. Now looking at the behavior of those gold, and especially the gold miners, we can look at those two charts, which the white line is actually the gold miners ETF, the GDX. The red line is the S&P 500 ETF. All right, now looking back at March 2020, and this is what pretty much happens in every single stock market crash. We could see the white line, which is the gold miners, they recovered in only 1 month. We made the low on March 2020. In April 20, they were back to break even. By the time the S&P 500, which is the red line here, actually recovered, gold miners were making a new all-time high, and the price of gold pretty much touched pretty close to 2,000, and then they made another high whenever we had the start of the war in Ukraine and a couple of other things. But this is the behavior of gold. Gold always recover first in a stock market crash. So if we did really bottom in the S&P 500, gold could be a leading indicator. But as I don't believe that we actually bottomed, if we do crash again going into 2023, the gold miners are going to crash with the S&P 500, but they're always going to recover first much quicker than what happens with other stocks, mainly and especially if the Fed does go back to QE and start printing money. This is a perfect environment for such stocks, and I'm gonna talk about that a little bit more right now. Now looking at this, another chart which is a very interesting chart that I would like to share here today, and this is again the white line, which are real yields. What are real interest rate? It's the interest rate of the 10-year minus inflation expectations over the next 30 years. This is not the current inflation. I'm talking about the future inflation expectations, which what the Fed actually looks at, and this is what many gold investors look at as they try to discount it into the future. Now on current inflation rates, the real yield is actually negative. But if we take the 10-year treasury, which is yielding around 3.5%, and long-term inflation expectations are still at only 2%, believe it or not, as the markets still have confidence on the Federal Reserve. Taking those two numbers, we take the 10-year minus the inflation expectation rate, which is 2%, we get 1.16% real yield in terms of those treasuries, which again, a lot of things can change here, but I'm going to talk about it a little bit soon. So as you could see now, as real yields have started to come down, because the 10-year is starting to get bid up, what has been happening? The red line, which is the GDX miners type of ETF, have started to go up, and they always pretty much inverse each other's. This one here in the blue shows the correlation, and they have a very negative correlation, meaning whenever real yields go up, gold miners get killed, and the opposite is true. Now, the main thing with this chart that I want you to take away is if you believe the Fed is going to pivot with inflation above 2%, gold miners are going to do amazingly well. And you may ask, why would this happen? First of all, whenever the Fed is forced to cut rates, as they raise a lot, if you believe something systemically could potentially happen in 2023, or maybe they just decide to take a victory early on inflation because it went to 5%, so then they cut rates to 2 or 3% and for something not to break, which is what's been happening in the latest Powell speech. Powell was more pretty much concerned about nothing breaking than actually about fighting inflation, and the market is actually catching to that, and real yields are coming down. But if the Fed does pivot with inflation above 2%, inflation expectations of the long term, which are 2%, they're going to move to 3 to 4%, and then the 10-year is going to go down, or it could even go up. But again, real yields will start coming down because of inflation expectation. And if real yields start coming down, then gold miners and even the price of gold or silver miners could start going up, and they could perform amazingly well. And as my thesis is that we could have something like the 1970s, where the Fed is forced to pivot with a little bit higher inflation than 2%, inflation expectations would rise, and then we would have sustained more sticky inflation around the 3, 4, 5% type of range rather than 2%. That way the Federal Reserve and many other central bankers would lose some credibility, and then many of those junior gold miners in the 1970s went up more than 1,000%. Some of them went up 2,000 to 3,000%. So they really performed amazingly well, and I believe we could have something like that in the future. And again, if that doesn't play out and it takes a long time to play out, I am fine with that, as many of those stocks like Newmont, which is one of the most popular and the biggest actually gold miner in the world, is yielding 4.5% dividend. This is one of the highest dividend yield it yielded since the 2008 financial crisis. I don't have any data before that, but I'm sure it's one of its highest yields ever at around 4.5%, and you could see how bearish investors are pretty much on the industry. Now, their cost per production, most gold miners are around $1,250 per ounce. So as long as gold is above $1,250 per ounce, many of them are going to be very profitable. They can actually raise their dividends, do some CapEx in production, and even pay down debt, and do many things to return shareholder value. So this is my thesis on gold. But I'm not saying you should go and FOMO all in gold miners right now after this big 40% type of move. We do have another high CPI number that could change, the perception a little bit. Maybe it could cause the 10-year to sell off, causing yields to go up, and then real yields would rise again, and then gold could go back down a little bit, and that could create another buying opportunity. But I believe, there's a decent chance that some of those gold miners have actually bottom, but I don't think people should FOMO. I think people should take a disciplined approach if they want to get exposure to this industry. And the best part is many of them, like Barrick Gold and others, they have very high dividends, which really you could get paid while you wait for such an event to happen. All right, so this is my thesis on gold and the gold miners. I hope you enjoyed this video. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.